Okay, so for those of you who I've lost because of all the geeky stuff, back here, back to reality, we start with what is called Markowitz, means logic invest, and here comes also the off-the-shelf part, the very easy to use things which you can just grab and implement. First of all, our own, let's call it development cycle. We also ourselves, we started thinking in terms of single strategy. Take something, invest in it, be happy, that's it. The more we work on our own portfolio, we think about more integrating into portfolio, which again is a fixed weight, 30% in that, 40% in that, up to 100% it should be. And the more we think about that, we now come to the part where it becomes dynamic. Hey, what about if the bond strategy is not working anymore? Yeah, what about what else? We have a long bull market. Shouldn't that whole portfolio be more adaptive in itself? Okay, and this was the reason why we started with, here it's called dynamic portfolio solutions, meta strategies. And then we also now started getting some requests, hey, could you do that and that for me in a more customized way? Okay, we love that stuff, we do it. Yeah. So this is kind of our chronological event, very short. We are only in that team since a little bit more about 2 years. How does that look like? What the market currently offers you, if you put that on a classical annual return volatility plot, is like that. In the last 7 years, S&P 500 has brought you a meager 10% with a volatility higher than 20%. Because I'm including the crash, yes. Gold, lousy, because of the 2013 correction of 20-something%. Long-term treasuries, 8%, 16% volatility in bonds. Isn't that incredible? And risk-free, not even a peanut. 0, actually getting negative. And again, this is not a sales pitch here, this is just, this is also affecting myself. Yeah, so how do our strategies fit in here? Here comes the bug, permanent portfolio. Easygoing, playing with a lot of elements, good in an inflation environment. Here comes the bug leveraged. This leverages opportunistically whenever the volatility is low or too low, and scales down whenever the volatility is too high. Here comes the bond rotation. In the backtest, the last 7 years, doing about 17% with a volatility lower than 10%. And here comes the universal investment plain version, also doing roughly 18-19% with a volatility slightly above 10%.
Question. These are annual returns?
Yes.
Total annual?
Yes, this is compounded average growth rate, CAGR. Yeah. Annual return for the time period 2008, March 2015. And no, I'm not telling you this is going to be the same the next years. Just telling you this is how it would have been or has been.
And what's your measure for risk at the bottom?
Annualized volatility. Global sectors, we have one version low volatility and one aggressive. Global market rotation. Global market enhanced, which means we add a little bit of volatility ETF to it. And that's, let's say, the spectrum for most of the people. Yeah. If you want something more aggressive, okay, global sectors. We have our maximum yield. And again, here I'm telling you the strategy in the backtest from 2008 to March 2015 has performed as 54% annual growth rate with a volatility of less than 30%. And I'm not telling you this is going to be steady in the next couple of years. And we have what Al named the hell on fire universal investment strategy. This is employing 3 times leveraged ETF, extremely aggressive. But this is, let's say, the universe of the strategies we have developed so far, plus some advanced options, alternatives you can use. Why the Markowitz? Because if you fit now a classical Markowitz efficient frontier about that, you basically can see all the possible portfolio variations you can construct with that. Which again means by taking 2 or 3 of these strategies, blending them together with different percentages, you can put yourself wherever you want to be. Either down here or up here. For the past, I'm not telling you this is going to be the same in the future. This is my standard disclaimer, sorry for that. And we have pre-configured some portfolios. For example, if you want to have a classical minimum variance or minimum volatility portfolio of these strategies, this is where you would be located. And then in steps of 10% volatility, these are also some portfolios we have configured already. So you would just go to our site and say, I want to have a maximum return, but limit my volatility to 15%, which is above more or less S&P 500 level. Then you would get to that red dot here, which is using or blending together some of these strategies here.
Just a quick one on this bottom one, where you have the S&P 500 at 8%. If you had been invested through, does that mean if you were invested 100% in equities, that's what you would have gotten?
Yes.
So it's been really higher. I mean, we've seen these big investments. So what can you just explain this to us?
Again, this is if you would have been invested in the S&P 500 from January 2008 until March 2015, which includes the correction and then the long bull market, you would have gotten an 8% rounded average annual return per year. And the green line means these are your possible portfolio blends, classical asset allocation with these assets.
I'm looking at the further to the right. I'm assuming that this was based on a monthly rebalancing or asset allocation?
Yes.
I just came across a paper in the last week that analyzed doing it monthly and how it came out as far as maximum drawdown.
Yeah.
Doing it weekly, which actually reduced the maximum drawdown and increased the return. Have you looked at that with
Yes. This is also one of the questions we very often. See, the reason why we do monthly rotation is twofold. One is, in all the backtests we have done or I have done is, whenever you go from monthly to weekly to daily, in my backtest the performance drops. Yes, you're getting faster, you're getting more reactive to what changes, but you're also getting subject to much more whipsaw. Yeah. So even over optimizing everything, I cannot find anything which would be stable on a weekly level. And here comes the but. For myself as a very, very lazy investor, because that's the second argument. I just want to have it easy going and not spend too much time also on that. I invest, and it also helps your discipline. Yeah, stop watching the chart. Yeah, during the month, watch the charts on the last weekend of the month, invest your money, and forget about it again. Or obviously forget in the sense of be interested, but not overreacting. Yeah.
So what time of the month? Is it consistently, you said the last weekend?
Yes, and that's the other part. We normally do end of the month, which means we trade the first day after the month end. After. And there you have the second effect, which is called the end of the month effect. Yeah, which is not as significant anymore. We just wrote an article about that. It's going down, but there's still a little bit additional benefit you can make.
Question is about seasonality. And does your algorithm wash this out?
We don't go into seasonality at all.
No, in other words, the way you approach it washes it out because it self-adjusts.
Yes.
Is that right?
Yes. We do not care about any, or we have not done any seasonality, no buy in May and go away things, nothing. Yeah. These things exist, but it's just we have not been doing that.
So you trade on the first day of the month, irrespective of any seasonality?
Yes. And actually even that, we normally tell people we cut at the month end, 4 p.m. After the close, we cut, we start preparing our stuff. And then we normally tell our investors, by myself, first day or second day, actually doesn't matter so much. Over longer periods, it's a wash, yeah, and it might be 0.something% less or more. And here comes the stuff I promised Al to come with something which nobody else has seen. That's that part here, meta strategy. Again, we have been talking at our side about that a long time. We are very also passionate about that, to do it, use it by ourselves, and we have it now automated. And I'm going to show you some examples of how here we now are magically able to extend Markowitz efficient front line by some little percentages. And again, we call that strategy of strategy. You take certain strategies and do not blend them together fixed weight, but rather adaptively over the time. Just because of time limitation, I'm not going to jump into that slide too much in detail, but here are some of the benefits we see from these meta strategies.
Your time sample from 2008 to 2015 is 7 years. Is that a large enough sample to strategies will behave in this way in future market conditions?
Correct. Whenever we put all our strategy in one slide, our major limitation is that some of these ETFs were not available before a certain time frame. For example, volatility ETF just started in 2011. Some other ETF were only available 2010-9. So for these charts, I do have to cut and start for all strategies 2008. Yeah, again, individual strategies, bond rotation, universal, the backtests are at least 20 years. Yeah, for that chart, I do have to fix the window.
In your universe of testing, did you ever have a period of time when the market was going down at a time when bond prices were going down? In other words, that other quadrant is so even.
Can I also defer you just a couple of minutes more to the Q&A? So I finish that and then we dive into all these very, very valid questions.
Because that's the big risk.
I agree with you. Strategies of strategies. Again, just to outline some of the benefits we expect for ourselves. One of them covers what if a strategy doesn't work anymore? What if the market environment changes? And with that also we offer some very powerful knobs which you can tune, whether you want to have momentum, sharp optimization, the question we had before, rebalancing quarterly, monthly, bi-weekly, daily. What vehicle you want to use for hedging, bonds, commodities, volatility scaling or risk parity. What about exposure? Do you want to deleverage, positively leverage? How sensitive do you want to be to changes in volatility in the market, what we call our volatility attenuator? Do you want to have a certain fixed minimum weight in a certain strategy, like 20% always in bonds or 60% permanently in bond? And these are kind of the knobs we're making available for that, and that's also why it took a while us to come up with that. This is our, let's call it proprietary backtesting software. We have just written to our own tool, but we also very frequently show screenshots of that.
Yeah, if you have an algorithm for a strategy, the algorithm will have a set of parameters.
Yeah.
And usually, I've seen it test the robustness of this algorithm, make sure that the parameters are robust, that's stable. In the strategy of the strategy, it looks like you're increasing the number of parameters in this investment approach. Is your aim change the way you test this robustness in these parameters? Because it's increased a lot of parameters.
Correct. There is a certain risk of overfitting or over-parameterizing because you indeed increase the knobs and the complexity. I show you some screenshots later in big, in the next slide, how we test also for robustness here. Yeah, what changes if you tune here? Is it still robust? What happens if you tune here? Is it still robust? But I agree with you, it's a risk. The more knobs you have, the more you can over-optimize. Yeah. But here I'm just trying to show you some of the elements we make available. And here's some live examples, and I just did these the last couple of days. This is too small to read, but here in red, for example, are bonds. In yellow, our so-called universal investments, and in green, our maximum yields. And you can see this is going back to 2002. Depending on the volatility in the market, yeah, our algorithm here scales down, so we have times where we are not fully invested. This is especially in the crisis years. So we said we want to have a 10% volatility each month. The market volatility is higher than 10%. We take investment out and put it into cash. And you can see here how stable this dynamic approach is. You have a maximum drawdown here still of 15%. Yeah, but you have a Sharpe ratio above 2.
Okay, so when you say you take out and put it into cash,
yeah,
what does that mean? You actually put it into cash and it's just sitting there, or you put it in the treasury, some other, lower risk vehicle?
Good question. And I would say it depends. Again, why we are scaling out? Because the volatility is too low for our appetite.
Understood.
Yeah? The volatility is too high. Sorry,
I just want to know what you mean by put it into cash.
Cash. Really cash or cash ETF. Yeah? We do not invest it into bonds or other things, because then again you would tune the market there.
Right.
Yeah?
Yeah, but even a cash ETF is invested in some security, such as T-bills or
exactly.
Whatever.
But for example, T-bills, yeah, it's cash equivalent in our terms.
Oh, okay, that's what I'm trying to understand.
Yeah. The second example here is, again, we limit volatility to 15%. We use universal investment and maximum yields. And also here you can see how stable normally the allocations are. This is every couple of months only, we will shift a little bit more into yellow or a little bit more into red. But overall, you can see this is roughly a 50-50 split.
Yes, what mechanisms do you have for, what mechanisms does your organization have to ensure that there are no glitches in the practical input of all these factors?
And I can assure you, here we have, is there anybody else who's currently using our services? I've seen your name. Okay, then you're all aware, for example, we had already in our emails, there are plenty of typos, yeah, and there are also sometimes where we say, okay, we changed something, yeah, and we're human enough also to say that then. But a technical glitch in a way that we said, oh, we're completely off or we screwed it, yeah, not so far. Yeah. How do we ensure that? By testing and by quality control.
For the control?
Quality control. That before we send something out, we read it 3 times and we have 2 partners of us check it.
I just have a minor request. Or actually, it's really for me more than a minor request. I have 2 large high-resolution monitors. I still find your website hard to read. As the slides up.
Too small or?
Too small.
This we can change.
And more graphic quantification, more graphic indication of the different metrics would be helpful.
All these things, for example, also we are very open and we request also feedback very often. Drop us a line and mostly in 1 or 2 things a day we have implemented whatever you want. Yeah, for example, most of the indicator we share, yeah, we have received requests, could you change that to a certain way or adaptive? So we try to hear what people are saying.
I'm still not clear about the actual mechanism for quality control, because, you know, after all, we're only human.
Yes. Yes, again, when I write something, yeah, I would send the article to my other 3 partners, they would review it. If they find something, they would correct it and send it back. This is our quality control. Is it perfect? No.
She was next, and then I'll go.
You said that once you've done this, you create a whole hands-off process so that
Yes.
you're not actually doing that. Is that a computer program you have written, or is there something off the shelf that could do that you could, in other words, how do you do that? How would I do that?
Our, let's call it back office, yes, we have a server or we have servers running with these programs. We're using some of the shelf programs. One is called QuantTrader. Army Broker or others would do the same thing. We use that one. And these things run on our servers 24 hours and they update everything after the market close, once a day.
And it's called Quant?
The specific program we're using is called QuantTrader. Yeah.
Thank you.
Going back to the latest question, avoiding glitches with your data, what is your data source? What company do you use?
And this is also one of the discussions we have. We currently use public available data, which is Yahoo Finance. Yeah.
Yahoo Finance?
We do have. Yes, and no. We received, and this is one of the discussions we have. For monthly rebalancing, things like that, we don't have any problem in using that, for example. Yeah. There are some discussions for dividends are not rightly adjusted or other things. In these monthly strategies for creating the signals, no issue at all. No?
Okay, so you're talking about your servers. So I assume your servers are sitting in some hosted data center that's like run by IBM or some other
Amazon.
Pardon me?
Amazon. Amazon Web Service, AWS.
Oh, Amazon.
Yeah.
Oh, okay. Amazon Web Services. Something like that.
I think the servers here is in Seattle, actually.
How far back does the Yahoo Finance database go?
Depending on the equity you're looking at. Individual stocks back into the 50s, indices back to 20s, ETFs since inception.
Could you say a little bit about, since you and your partners have never met physically, could you say a little bit about your collaboration process? How you work together and how you share thoughts and whose strengths are what and so forth?
The way we work together physically is, or not physically, virtually, is we have calls every 3-4 days, normally twice a week. Depending on the projects we have, we have bilateral calls, projects calls. Also, it's not only the 4 of us, we have another 3 people working loosely with us. These are not contract people, but they are good coders and enjoy what we are doing, so we're working loosely with them. Other than that, different online services we are using just to keep ourselves informed. Yeah.
Why don't we have a drawing for the books, and whoever has a magic ticket can pick between the books we have, and we'll just go into full bore into the Q&A session. I'm going to ask our speaker, Alex, would you pick a ticket out of there?
Yeah, thanks a lot.
And read the number.
It's 769297.
Got it? Okay. Go pick it after, there's one book underneath the projector at the end of the program.
Who got it?
Yeah.
769297.
Is that right?
That's perfect. Congratulations.
Okay, thank you. If you want to read, this is the book up here is The Richest Man in Babylon.
Okay.
And then
So we go on the back.
So you pick one of those or this one. You can't have this one, it's no projector. It's under Richest Man in Babylon. It's a thin little book. It's strict. It's basically spend.
It's not available right now. Before we actively now into more questions, let me just finish off with one more slide. So again, these are just examples to show you here what a little bit more the bones of what we are doing. If you want to try that out, yeah, or use it and employ it, and again, we have some active people also sitting here. The process is really meant to be as easy as it could be, not to take more than 10 or 15 minutes for rebalancing each month. So once, for example, you would go to our site and choose really with a very simple tool which strategies you would like to invest. You would get the KPIs, what's the drawdown, what's the weekly drawdown, what's the Sortino, what's the Sharp, whatever is the indicator you most enjoy. You can play around that. It's very interactive. You just change the percentages or select some of the pre-configured options. And this is really a one-time effort. Once you have done that, every month end, we send out a classical signal, emails, but we can also go to our site and get the consolidated signals. So even if you would set up a very complex portfolio consisting of 5 different strategies with different weightings, we will just at the end tell you these are the shares you should at the end maintain in your portfolio, and then you would go to your broker and rebalance that in a very simple 5-minute step. And again, for the execution, this is not automated. We do not plan to automate it. If you're looking for that, then we are just the wrong partner. At the end, we are much more on the do-it-yourself side, but again, Schwab, Interactive Brokers, and any others also would support that.
So when you say drawdown, you're assuming people are taking out monthly drawdowns for income, whereas if you're not taking any...
No. No, drawdown in a technical term, what was the highest peak to through drawdown over a certain period.
Okay, I want to understand what you meant.
And we also show you durations, or what was the time to recover, average duration, whatever. This is what I meant. If there's any requirements, a lot of that stuff I got by request and said, okay, we do that. Other things I say, it's just only few people want that, so I would vote that down. And this is a very democratic process here.
Alex, I'm still concerned about, for instance, you guys have some ETFs like EDV and ZIV and XIV.
Yeah.
You know, let's say you have, I don't know, 5,000 subscribers. They're all rotating into some of those instruments in a month, and you know those are relatively, you know, relative to like a TLT and SPY, relatively illiquid. You know, can you address that?
It is something which is hard to deal with. Yeah, for example, EDV and TLT, we really had a ongoing long discussion of for several months. EDV in our eyes is still the best one to go with, acknowledging that's the lower liquidity. People who have a margin account or people who are able to go leverage ETF, for example, they can go then TLT and leverage up. So we give that options. Yeah. Now, how to deal with your potential critique that we are moving the market? Yeah. So somebody investing with us would actually have a higher spread. The only subjective thing I have is we're just too small. Yeah. Are we going after having 50,000 subscribers and then really moving the market? No. Yeah. Again, we are an advanced block, yeah, with a lot of discussion and forum. Yeah, we are not an institutional investor or a somebody who offers you off-the-shelf things. Yeah.
And is QuantTrader something you guys built, or that's on top of another platform?
No, this is built from scratch.
Oh,
this is really.
So how do you charge for the services?
How do we charge for the services? Currently, you can, it goes a little bit to this chart. Let me go back to that. Depending on what you need, if you already have your portfolio, say, but I'm interested in the UIS, for example, okay, then you just grab the universal investment strategy, and that's 30 months a buck. No, the other way around, $30 a month. Yeah. If you say, I like what you're doing, I'm interested to set up my whole portfolio with you, and I would like to buy that red part here, for example, targeted 15%. Then you would subscribe to all strategies or a certain meta strategy. Yeah. The all strategy subscription currently is $100 a month. The meta strategy, again, nobody else has seen that before you. Pricing is not yet decided. Our prices are really only to recover a little bit of what we're also investing. For none of us, this is really a big business. It's more a side revenue we also have.
So the meta strategy would be more than $100 a month?
Most probably less, because it's just a simple portfolio.
But if you're at $100, you would get the meta strategy?
Yes, you get everything. Yeah. And the $100, we always say this is what we have and what we will have in future.
Back to my question on the quadrants. If you take rising rates, falling rates, rising market, falling market. I've seen a graph presented here actually last year. There's almost never a time in recent history when we had both falling bond prices and falling stock prices. So the question is, do you have any data on a period like that? And does it even make any difference in your strategy? So it's really two questions.
The strategy which is most universal in that sense, because it's really catered for different environments, as you're saying, is the permanent portfolio. Yeah, because there you, in the classical sense as you're describing it, because you have the gold part, which is inflationary, you have the equity, you have the bond part. This is the famous chart I imagine you're referring to.
So by that you mean the mutual fund, permanent portfolio?
There are mutual fund solutions out there, yeah, but again, our bug here, this is what we call our enhanced permanent portfolio. Yeah, but again, it's located here. But maybe a couple of opinions on this ongoing discussions regarding rising interest rate. What our research or reading of the current market analyst is, plus what we also imagine ourselves, and again this is highly subjective now, is we do not expect the Fed to increase the rates even this year. I think we're just in a period of pushing the can little by little. If the rates increase, it will be quarter of a point, yeah. Slowly, slowly, slowly. Why? Because, again, this is my own reading of finance, is because the Fed is just crunched between dollar going up, a lot of macro events outside there, so they're not able to go quickly to the level wherever it is they would like to go. Yeah. And the other thing, which again we just subjectively expect, and I have no other argument that I'm just telling you verbally here, is we do expect that the market is just overdue for a nice correction, yeah, which will come. If and when this comes, nobody will care about interest rates. The bond will just go up again, and then we have our old mechanism in place.
You're saying the bug offers the most protection.
Pardon me?
The bug offers the most protection.
Again, the philosophy of the permanent portfolio, as it was designed, is for these four quartiles. Yeah, equity going up, low inflation; equity going up, high inflation. And in that very classical sense, this is the strategy to go if you're a fan of that philosophy. Yeah. It is very, very conservative. Yeah, both the original and also ours. It sits down here. Yeah, it has a very, very nice history, a lot of documentation, a lot of academic research. If you love that and believe in it, it's your thing to go.
All right, I just had one quick question. You said you were going to give your email address and you didn't.
Oh, not yet. I have it here. Again, if you go to our site, I have also today received 2 feedbacks. Yes, it is confusing. Yes, there's too much stuff to read there, but that's the plus. Yeah, if you want to educate, entertain yourself, and discuss with other people, we have a very good community which is discussing, and this is why our forum and also our blog is very long. Yeah, but we also publish short white papers on all of our strategies, and we also have the version of don't even look at our site, you just get our emails per month. It really depends on your level of engagement you're looking for. Yeah. If you want to contact me, please do so. Either Alexander Horn, logicalinvest.com. You can Skype me or drop me a message over chat, Alexander Horn 672. Our site is logicalinvest.com. If you want to phone me, I have some cards which I just made because of the purpose of this trip. I can pass them around if you want. Maybe it's the easiest. And the people who have been on our side, we try to be interactive and going back and forth. Yeah.
For any of you who can't.
Pardon me?
For any of you who can't see it, it's www.logical-invest.com. That's the website for the website. That's the website.
I'm not sure if this is included in the printout you have, but in the presentation, which will be online, there's also a short description of all of our strategies with recent performance drop. So here, this is too small, but you can read it on your bond rotation, for example. You will see 3-month performance, 12-month performance, and since inception.
Do you give the actual ETFs on there?
Yes, all that stuff is there. Yeah, and this is just a screenshot from our website. So this is what you get updated there every day.
You probably already stated this. Which one did the best in 2008?
Best in terms of what?
Best performance.
Okay, the best performance in 2008 was keep it steady, don't lose. Yeah.
Which one of your strategies in the portfolio?
It still depends on what you were looking for. Did you look for the strategy which had the smallest loss, the smallest drawdown? Then this was definitely the bond, and also the buck.
The bond.
Yeah. The question is tricky because those two then also were very lazy in taking the rebound. Yeah. So the more aggressive one, maybe they went down a little bit more, but they also were much faster and then taking the lift up. Yeah. Again, this why I'm talking casual like that. This is very subjective, especially these drawdown things. You have to ask your stomach of how much drawdown is permitted. You have to feel it also. You have to put yourself in a situation where you're losing 20% of your money. You still have the confidence to stick to the strategy. Do you trust these guys? Yeah. Do you trust this strategy? And that's very much guts.
Quick interrupter. Just so everybody knows, all these slides, including all the slides and the individual strategies, will be posted in about 24 hours on the website, so you'll be able to see them all. Alex's slides are very good in the point that he provides links directly to the articles on his website. Talk about these items. Third point I make is on the handout information sheet. You should have, there's going to be one slide on there that provides the address to the free offer that Alex is making. So.
And again, I'm going to be here. My only purpose was to be here today with you. I'm here whole day and also the full day of tomorrow. If spontaneous there's any interested, we can meet here to discuss and be more in detail. Yeah, just drop me a line.
Just a quick question. Do you compare those out-of-sample results with your backtest results?
This is one of the things also I told Al. Again, we're publishing basically everything. We have some things we consider proprietary, and this is exactly part of that is the backtesting. Yeah, we have a very complex what's called walk-forward testing. Yeah, and this is just something which is so close to our heart that we won't publish it. Yeah, but yes, also if you have a custom backtest request, test the strategy with certain mutual funds over that years, drop us a note, and we try our best to do it.
Okay, let's make this the last question because we're heading toward the limit on the room occupation cost and there did. So maybe one more question.
What I notice is that in the later performance of the strategies, you're able to show performance of cash trading. And in the earlier parts, they are backtest. Now, is this forward walk type of backtest? And also, you have been trading your own money. How closely do you find that your own trading in your brokerage accounts matches what you're able to show in your simulations?
You typically, I'm track it, and I'm typically off on a monthly base plus minus 0.2.
So it's pretty close.
This is pretty close. Why plus minus? Because we close one day and next day then it kind of gaps up or down, but it's pretty close. Then you have to deduct. Tax obviously is not included.
I don't understand.
Yeah.
So slippage is very little, is what you're telling me. And are the back tests, the type of back test that you walk forward in your data?
The walk forward is basically to determine the parameters we're using. The look back period, for example, is we do a walk forward testing. So each year, basically, we ignore what has happened in last year. We just look, in that year, what would have been the best parameter. We apply that for 1 year, and then we rinse and repeat each year. Very complicated process, but it's very robust. It avoids a lot of the curve fitting discussion. But because of that, also, we're a little bit hesitant to show that part.
Well, but you're essentially curve fitting because you are taking the latest data and projecting that in the near future.
No, because this is, again, technical, but this is, in my conviction, the best way to avoid curve fitting. Walk forward. You test 1 year, yeah, adapt your parameter in the range which would have been best, and apply that to 1 year ahead. And that year, again, only 1 year back testing, yeah, but again, you avoid the curve fitting from looking over the whole past.
It's a philosophical. Yeah.
But let's discuss that, for example. This is one of the nice topics.
One last question in the vein of true disclosure or open disclosure. Do each one of your partners, including yourself, show what strategies you are investing in on a monthly basis relative to your own portfolios? So, an investment advisor that I've been talking to says, we let you know where we're putting our money, and so consequently, we're not going to put you into something that we won't put our own money into. You get where I'm going?
Yeah, again, this is a lot of sweet talk for myself. We have not got to the point where I would put my account statement on the side.
No, not just your portfolio and what percentage of your total assets you've got invested in each one of the portfolios.
Yes, and this is something, for example, we could or we should maybe publish on the site. Yeah. Myself, I'm very, very conservative, again, because I live from my income. I'm very much on the bond side. Universal investment, I'm invested since last year. And I'm also doing sometimes opportunistically, like I showed you, the advanced stuff, investing in roll losses, 3 times leveraged or volatility.
A possible solution to this is there are third-party auditors that track like market timing strategies, so like data research and timer track, so you can give them your signals and you can track notify about other trends.
See, and again, also here, I can just put my nicest face and say, we are not good in marketing, and this is not our purpose. We like that research stuff, we like the exchange, but on the marketing side, we know we should be more professional here.
I think we're going to probably have to call an end to the formal questions. I think you're going to stay around for a while and answer questions. So those of you who are getting cut off, feel free to talk now.
If not, we just go outside. Thanks a lot.
Can I get your card?
Yes, of course.